Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LEGENCE Corp annual report. LEGENCE Corp offers a wide range of services to its clients across various industries. At the core of their business are engineering, installation, and maintenance services for mission-critical systems in buildings. Their engineering and consulting segment provides design and development of HVAC and MEP systems, as well as strategies to reduce energy usage and make buildings more sustainable. The company's installation and maintenance segment is responsible for fabricating and installing HVAC systems, process piping, and other MEP systems in new and existing buildings. They also offer ongoing maintenance services, including preventative and corrective maintenance, emergency repair, and break-fix services. Additionally, LEGENCE Corp provides facility energy analysis, automation, optimization, system certification, and testing. Their services cater to various markets, including data centers, technology, life sciences, healthcare, education, mixed-use, state and local government, and others. With a rich history dating back to 1914, LEGENCE Corp has established itself as a trusted provider of engineering and installation services in the United States. LEGENCE Corp maintains a market capitalization of $6 billion, broadly in line with the industry peer group. LEGENCE Corp trades at a higher price-to-book ratio of 9.09 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 71% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline are multifaceted and influenced by various factors. On the growth side, expansion of fabrication capabilities and capacity, merger and acquisition strategies, increase in volume of project activity, timing and amount of revenue recognized, and remaining performance obligations all contribute to revenue growth. These factors have resulted in significant gains, with over $5 million in EBITDA gained from mergers and acquisitions. On the decline side, lower customer demand, delayed contract awards, uncertainty that revenue will be realized for point-in-time contracts, and lower revenue projections due to investments in support functions are the primary drivers of revenue decline. These factors have had a negative impact on revenue growth, particularly in 2023, 2024, and 2025. It is also worth noting that changes in variable consideration estimates, dispute resolution developments and outcomes, anticipated negotiation results, and customer retention arrangements can drive both revenue growth and decline. These factors highlight the complexity of revenue management and the need for companies to carefully monitor and adjust their strategies accordingly. Net income experienced a decline in 2024 by $18.4 million compared to 2023. Primarily due to goodwill impairment charges. These charges were incurred in 2025, $25 million, 2024, $17.8 million, and 2023, $5.1 million. The absence of specific information for 2025 suggests that the trend may have continued. Profit margins underwent fluctuations across different segments. In the engineering and consulting segment, margins decreased due to lower sustainability, consulting revenue, and contract amendments. Conversely, in the installation and maintenance segment, profit margins increased due to higher revenue from larger projects with better margins. However, overall profit margins fluctuated due to changes in project scope, input costs, and productivity. The primary reasons for these changes include goodwill impairment charges resulting from declining projected cash flows, lower revenue projections primarily caused by delayed contract awards and uncertainty of revenue realization, and the complexity of estimating cost to complete for contracts using the cost-to-cost input method. The company's financial performance is a testament to its ability to generate positive operating cash flow. Over the past 3 years, the company has consistently demonstrated a strong capacity for generating cash from its core operations. In 2025, the company generated an impressive $256,873 in positive operating cash flow, indicating a significant increase from previous years. This trend is also evident in 2024 and 2023, where the company reported $29,268 and $33,917 respectively. These figures not only confirm the company's ability to generate positive cash flows, but also suggest a growing trend. Furthermore, page 111 of the report provides additional confirmation that operating cash flows from operating leases are also contributing positively to the overall financial performance of the company. This comprehensive analysis suggests that the company is on a solid footing in terms of its ability to generate positive operating cash flow. The company's debt level has undergone significant fluctuations over the past few years. While there were instances where the debt level decreased, such as a decrease of $792.6 million in 2025 compared to 2024, and a total debt reduction from $1,624,649 in 2024 to $835,759 in 2025. There were also periods where it increased. For example, long-term debt saw an increase from $103,500 in 2023 to $2,968,000 in 2025. Interest expenses have also changed over time. The interest expense increased by $10,169, 11.1%, from 2024 to 2025, and there were instances where it decreased, such as a decrease of $23,413, or 34.3%, from 2023 to 2024. However, the overall trend in interest expenses is an increase, with some fluctuations along the way. In summary, while the company's debt level has seen significant changes over time, including both decreases and increases, the interest expenses have generally increased, albeit with some fluctuations. The performance of various segments and regions within a company has been analyzed, revealing both strong and weak areas. The installation and maintenance segment stood out as a top performer, with its installation and fabrication services accounting for 82% of revenues in 2025. This segment also saw significant revenue growth, increasing by 21.9%, while gross profit rose by 31.6%. Additionally, the engineering and consulting segment experienced notable growth, with revenue and gross profit rising by 20.7% and 16.5%, respectively. In contrast, there were no segments or regions explicitly stated as performing poorly. However, it was noted that maintenance and service work within the installation and maintenance segment may have lower profit margins compared to installation and fabrication services. Furthermore, while the total engineering and consulting and installation and maintenance segments experienced growth, their year-over-year growth rates were lower than those of their respective subsegments. The analysis did not highlight any specific regions as underperforming or struggling. Nevertheless, it was mentioned that other international locations faced difficulties in attracting customers and incurred increased costs. Overall, the data suggests a mixed performance across various segments and regions, with some areas excelling while others require attention to improve profitability and growth. Management is optimistic about the company's future prospects, driven by a strategy of growth through acquisitions and investments in strategic initiatives. The company has successfully completed several acquisitions and plans to continue expanding its portfolio with larger projects that offer higher margins. To achieve this growth, management is focused on managing costs, including compensation expenses and IT expenditures. Additionally, they are prioritizing debt management, aiming to refinance existing debt facilities with more favorable terms. This will help reduce the company's financial burden and improve its overall cash flow. The company's outlook is also influenced by industry trends in the alternative energy sector, which has experienced lower customer demand, extended sales cycles, and project funding uncertainty. However, management believes that their expertise in infrastructure and energy industries will be essential for driving growth and success. Financial projections indicate a strong backlog of awarded contracts, enabling management to forecast future results and identify trends. Revenue recognition is based on transferring control of goods or services to customers, with most contracts featuring overtime performance obligations. Despite these positive developments, management acknowledges several risk factors that could impact the company's strategy. These include industry trends in the alternative energy sector, uncertainty surrounding tax benefits from the Tax Receivable Agreement, TRA, and potential debt management challenges. The company has made several strategic acquisitions to expand its capabilities and offerings. One notable acquisition is Bowers, which was acquired on page 25. Another significant acquisition is Metrics, also acquired on page 25. In addition to these two acquisitions, the company has also acquired P2S and AMA, both of which are mentioned on page 62. These acquisitions demonstrate the company's commitment to growth and expansion through strategic partnerships and investments. The company's financial performance for the year ending December 31, 2025, reveals some key information regarding its capital management strategy. Notably, the company has chosen not to pay dividends to its shareholders during this period. This decision suggests that the company is prioritizing other uses of its funds, such as reinvesting in the business or reducing debt. On the other hand, the company has engaged in share buybacks, repurchasing equity securities registered under Section 12 of the Exchange Act. Although the exact amount of shares bought back during this period is not specified, it indicates that the company is actively managing its capital structure and shareholder value through strategic share repurchases. There are concerns about inventory buildup or supply chain disruption. However, the primary concern is actually related to supply chain disruption. This can be attributed to various factors such as tariffs and trade actions that impact demand for services and increase costs, page 33. Additionally, external shocks like the COVID-19 pandemic, political disruptions, strikes, terrorism, and resource shortages can also cause significant disruptions to supply chains, page 36. While there is a mention of potential inventory buildup due to tariffs and trade restrictions affecting supply chain costs and logistics on page 50, it seems that this concern is not as prominent as the issue of supply chain disruption. Furthermore, the escalating transportation, commodity, and other supply chain costs and disruptions mentioned on page 69 also point towards concerns about supply chain disruption rather than inventory buildup. That concludes the financial summary for Legence Corp. Feel free to comment below, and I will be happy to answer them when possible.